Gerard, for a lot of people out there that have seen this run-up, melt-up in the last couple of weeks and say, am I too late? What do you say back to them?
I would say no. John, when we look at the banks, we're still seeing expectations for higher interest rates. The higher interest rates will lead to better profitability for the sector, and the tax rate cuts are obviously important. But the bigger impact for the banks is the expected growth that's coming from tax reform, and that will lead to stronger loan growth on top of higher interest rates.
Gerard, the pushback,
I would say you still can buy them.
The pushback, sir, is that the demand might not be there on the consumer and the business side. That the loan growth might be available, the supply might be there, ready to go, but no one wants to borrow. Do you see that changing? Because at the moment in the data, it looks a little softer.
You're right. The data certainly is softer, specifically in commercial lending. But when you look at commercial real estate and you look at the consumer side, we're seeing mid-single-digit growth. So if real GDP is going to accelerate next year, that should drive commercial loan growth stronger than it is today.
Mark Yusko?
But Gerard, how does GDP accelerate next year? One thing we know is that deficits and debt actually crowd out and lower economic growth. So it's likely that economic growth goes lower. Nominal GDP growth is equal to working age population growth plus productivity, both of which are sub 1%. So I don't know how we get this big boom in economic growth. And the C&I data says that loans are softening, credit card delinquencies are rising, student loan delinquencies are over 1/3 today. How is that positive for banks?
I would say first on the student loan side, that's us as taxpayers. The banks have nothing to do with the student lending. That's all U.S. government. So for the banks, that's not an issue. The delinquencies on credit cards, you got to remember we were at all-time record lows 2 years ago, and we're still at unusually low levels. So the credit card delinquencies don't really concern us unless unemployment starts to rise. But when you look at the Kennedy tax cuts and the Reagan tax cuts, both of those time periods within 4 quarters of the tax cuts, the economy in those time periods accelerated. And, of course, in the Reagan cuts, you remember all the deficits and the concerns about deficits crowding out borrowers, and it didn't happen, and it doesn't appear to be happening today. So as more people have money to spend, as well as corporates, traditionally, again, using the history as a guide, we would suggest we're going to see an accelerated GDP number when this kicks in.